What's going on, guys? It's Jimmy here. Welcome to our daily show where we discuss everything going on here in our country that you need to know about here on a daily basis. Okay, we got the major announcement here from the Federal Reserve, from the government, from Jerome Powell, the head of the Fed. And it's kind of what we expected, but the problem here is what is going to happen going forward. And this sent the stock market plummeting pretty badly here. And this, we could have had it worse. But the problem is what the Fed said about what is going to happen going forward. We got a lot to unpack here. We're going to get to it here in this video. So let's jump right in. Here is Jerome Powell with a quick excerpt of what he said today, and then I'll kind of we'll get into the details of this. So take a listen to this. Jerome Powell, the head of the Federal Reserve, making this major announcement here about inflation and raising interest rates and your money and how this is going to affect Americans, housing rates, credit card interest rates, and a lot of different things here for our economy. And this is going to send us into a recession. How deep of a recession, how this is going to affect the labor market, the job markets, and help going forward from here from the government, a lot of different things. Check this out.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation.
Now, a couple interesting things to note here. So the Fed is going to raise interest rates again by 0.75 points, 0.75%, also known as 75 basis points. It could have been as high as 100 basis points or 1%. It was a lower chance of that happening. That would have been the highest interest rate hike ever in the history of the United States. But this is the third time in a row that they have done this here, basically in about 3 months. So they have risen rates 0.75% 3 times in a row. So 2.25% interest rates have gone up now, basically in about 3 months. What was concerning here for the stock market and for everybody listening, just Americans in general, is that officials said higher for longer stance as the U.S. central bank tries to stamp out soaring prices and higher inflation, is that they're going to keep interest rates higher for longer, and that there will be more interest rate hikes coming after this. That's what was really concerning here. You can see here, Jerome Powell, another 75 basis point interest rate hike. Quote, "We can't fail in this inflation fight." This brings the new basis mark of the Fed Reserve interest rates to 3% to 3.25%. That's bank-to-bank rates. This will now bring home mortgage rates, which are already at, for like a 30-year fixed in California, which is the largest population state, they're already at 7%. So this is now going to send them higher. And again, this is for a 700 credit score. So this is going to send home interest rates even higher. So remember here that at the beginning of the year, we saw home interest rates as low as 3%. 3%. So this is a significant thing for millions of Americans. This is not going to affect just home interest rates, but just to give you an idea here, on a $300,000 home, a 3% interest rate, which you could have got at the beginning of this year. I mean, I don't know, maybe, 9 months, 12 months ago. In fact, you could get some actually lower than that, depending on the type of mortgage you got. A $300,000 home could have went for $1,265 a month, okay? But now at 7%, you can see here it goes to $2,000 a month. So we go from $1,265 to $2,000 a month for the exact same loan amount. So what is that a difference of? $735. That's only on a $300,000 home. In some places, you can buy a decent home for that, but in some places, you can't even touch a home for that at all, depending on real estate prices. So if we go with a $500,000 home, which again, some places you can't buy a home for that, a $500,000 home is 3%, $2,100. 7% is $3,300. Look at the difference there. It goes from $2,100 to $3,300. That's $1,200 more a month for the exact same home. The exact same home. But what we have seen is we have seen home prices come down dramatically. We had seen a 22-year low of home closings. And this is because we're not seeing the multiple bidder situation here. I'll actually get to here what Jerome Powell said, that we're going to have a reset of the home market. He sees a massive recession type coming here because of how high interest rates are getting. We're already seeing this in the car markets as well. Anything that you pay interest on, people are basically buying less on because it's costing a lot more. I mean, if the house is going to cost you $1,000 more, it's just unaffordable for some people. So that means renters, more people are going to be renting, which is actually could be raising prices for rent more because there's more demand for them, less demand for housing. You can kind of see what might happen there going forward. But what is happening on home prices is home prices are actually coming down. The prices of lumber has come down for actually quite a while now. Remember when we had that massive price spike in lumber? Lumber prices have come down for quite a while now. They're nowhere near the highs that they used to be. And remember, you need a lot of lumber to build homes. So that's a good thing. But also, that we're not seeing this multiple bidder situation where you would list a home for $300,000 and you would have 20 people bidding on it, and the ultimate end price would be $350,000. And no inspections and no contingencies and all that stuff, which was kind of crazy because you would buy a $300,000 home with no inspection. Like, in what world was that realistic? I mean, like, who would want to buy a $300,000 home without an inspection? It'd be like buying a used car without looking inside of it, now without test driving. It was just kind of weird, right? But that was the thing that like buyers had to do to like appease the sellers because they had 20 people bidding on the home, all over asking price, and the sellers basically like were at a candy store and they like got to pick the best candy that they wanted to, which was again a sign of an overinflated economy and very, very cheap money out there. Basically you could buy a home in the 2 to 3% interest rate range, and you get to write that off on your taxes in some cases. So you can see here, this announcement sent the stock market plummeting. It was actually in the green here today until we had that announcement, and then yeah, it plummeted. So down another 522 points here today for the Dow Jones. Um, we're back at around Dow 30,000 pretty much here, 30,183. So this recession is taking a toll here on a lot of people's 401ks, IRAs, pensions, which are mostly in the stock market. Remember that about 50% of Americans retire with money in the stock market. Pensions, IRAs, 401ks, even the bond market has been taking a very big toll here this year. What you decide to do obviously is your decision, but we're at a low point right now. You look at a 1-year chart here. A year ago, we were at around 35,000. Now we're at 30,000. So that's about a 15% drop here, just for round numbers, from a year ago. 5 years ago, we were at 22,000. So from 5 years ago, we are still significantly up from 22,000 to 30,000. But we are definitely at a 1-year low, you can see here. And it's just a lot of, a lot of people negative on the future of the short-term future of interest rates and inflation right now. The other thing here is Jerome Powell said that the U.S. housing market is headed for a correction. This is because that they're going to be raising interest rates for longer and higher and for a longer period of time than this. This was his actual wording here. You can see here. He says the chances of soft landing the economy will likely diminish in the pursuit of restoring price stability, which means we might not even have a soft landing. We're just going to potentially end in the dumper, and this could be a crash landing for the economy and for the United States because of this inflation battle we're fighting. And he's basically kind of saying they have no choice but to drastically raise interest rates and to crash the economy, is kind of what he's saying. He said, quote, "My main message has not changed since the Jackson Hole meeting. The FOMC is strongly resolved to bring inflation down to 2%, which we're nowhere close to, and we will keep at it until the job is done." With the FOMC now setting a, quote, "higher for longer" interest rate policy, the pace of the dance has picked up, increasing the risk that both spin out of control. The Fed increased its year-end rate to 4.4% from the 3.4% expected after the June meeting, which means there's going to be even more interest rates coming after this. Yeah, and probably even more next year as well. He also said that the U.S. housing market is headed for a correction. Here's an excerpt from a question he was asked about a great reset. Take a listen to this.
Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
So basically, the housing market is going to, if not, it's already started a correction. Correction would be a 20% drop in prices, home prices. So think about what your home might be worth or what current prices of homes are worth now. Subtract 20% of that, and that is what they're projecting. Remember that the Fed, it's not just Jerome Powell. He's not the only guy there. They all voted on this, and they unanimously voted on this interest rate hike, as has been the last several interest rate hikes as well. And they could have had a higher interest rate hike than this as well. Also remember that, not that I'm sticking up for the Fed or anything, just kind of bringing you guys the information here. Banks all around the world here are also doing the same thing as well. You can see here, Canada, Bank of Canada increased policy interest rates by 75 basis points as well, continuing their quantitative easing, quantitative tightening, just September 7th here, so about 2 weeks ago. So Bank of Canada doing the same thing. Their inflation numbers about the same as well. Their gas prices are actually higher than us if you equate them to U.S. gallons and U.S. dollars. So again, doing the same type of thing here. The EU, the European Union, same thing. The European Central Bank raises interest rates across the entire Eurozone by a record margin. So and this is for basically all of Europe, almost all of Europe's doing the same thing. We're seeing countries all around the world do pretty much this exact same thing. In fact, I remember when Russia, actually months ago, when Russia raised their interest rates in one shot from 9.5%, which is what it already was, to 20%. It went from 9.5% to 20%. To keep their currency, the ruble, from crashing. Imagine that type of interest rate hike. So we've gone up 2.25% here in about 3 months. They went from 9.5% to 20% in one shot. So they went up 10.5% in one shot. The move was aimed at countering risks of further depreciation in the ruble and hyperinflation. Even Russia's dealing with this stuff. So that's kind of why I like to share this kind of stuff with you, because depending on what media you listen to, whether it's right, left, or center, you might not hear these kind of things. And that's why I kind of like to, previously, I haven't done it for a while, but I show you gas prices around the world as well. A lot of people don't realize that gas prices around the world are actually a lot higher than in the US. The US is actually one of the lower, or one of the lowest, maybe I should say. There's a few countries that have lower gas prices than the US. We're not the absolute lowest in the world, but we're one of the lowest in the world. But like pretty much all of Europe has higher gas prices. Canada has higher gas prices than us. And really, you look around the world, most countries have higher gas prices than the US, believe it or not. And when our gas prices were going up to $5 a gallon on the average, of course, California is a much different price, much higher taxes there, and much higher. They have a different blend of gas. But countries all around the world were dealing with the same thing. When we had $5 a gallon gas, countries in Europe had $7, $8, and $9 a gallon gas if you did the equation and equated it to US dollars and US gallons. They have liters and different currencies there. So really, it's a global economy, and we're all kind of dealing with the same thing right now. The whole world is dealing with inflation. The whole world's dealing with high gas prices. Right now, natural gas prices are really spiking as we go into the winter months. That's going to be a problem. I'll keep you up to date on that. And I'll keep you up to date here on what the government might do going forward to help out our people, and what the response might be as well. Remember, this came from the Federal Reserve, which is kind of an extension of the government. So let me know your thoughts here. I just did a video on another major announcement coming out here on September 28th. I'll link you to that video next. So make sure to subscribe down below to our YouTube channel. It's completely free to do so. New videos come out here every day at 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. When you subscribe, click the bell icon down below. As I said, it's free, and this way you won't miss out on new videos. Here's my newest video on a major announcement coming out here on September 28th. This is hopefully probably going to be good news for millions of Americans as well. So click on that video next. Thanks for watching, guys, and I will see you in the next video.